Hello everybody, I'm Mrs. De Mailon, and today we are going to look at Accounting Paper 1 and what to look out for when you are studying. So, when we first look at the scope of this paper, we start paper 1 mostly focuses on the financial aspect of accounting. So we're going to mainly look at the statements, the income statement, the balance sheet, the cash flow statement, and then the analysis of these three statements as well. Usually, yet again, these topics is about 3 to 5 questions, 150 marks for 2 hours. And we also incorporate corporate governance, ethics, professional bodies, and into all of these questions. So first of all, we're going to look at the income statement, or sometimes they refer to it as the statement of comprehensive income. You need to know the different wording and don't freak out too much all of a sudden. If it looks like an income statement, it probably is an income statement. So the income statement is based on the income and expenses of the business, calculating profit at the end of the year. So you cannot throw in assets and liabilities in here. It's only the nominal account section and only income and expenses. And guys, please, in matric, you cannot make a mistake to put in accrued expenses, accrued income, deferred income. Just because it says expense or income at the back of the word doesn't make it an income and expense. Those 5 accounts are liabilities or assets. They do not belong in an income statement. So the layout of an income statement is net sales. Net sales will have debtors' allowances already deducted from it. Minus your cost of sales gives you your gross profit, plus your operating income. That will exclude any interest. And then minus your operating expenses, yet again excluding interest, because interest is shown at the bottom. Interest income, interest expense is added or subtracted, and then you have minus your tax, gives you your net profit for the year. As I said, it's only your nominal account section, and remember, even though dividends on ordinary shares appears as an expense in your nominal section, this is the one item that they always catch you on, because it belongs in the retained income note. It's not an operating activity. It will form part of your retained income payouts. It's not in the income statement. Then, remember always to add your trading stock deficit, your depreciation, provision for bad debts adjustment. Now, the adjustment account is the income statement account. The provision for bad debts is not. That is the note 5, trade and other receivables. And then finally, your profit or your loss. Just getting back to the adjustment, remember if you adjust upwards, it's an expense, and if you adjust downwards, it is an income, and then it belongs in different sections. So remember that all of these things that you add will always be after you've calculated any of the adjustments at the end of the year. So you have to take all of the adjustments into account to calculate your depreciation. That will include the sale of an asset or trading stock deficit, any returns or losses or things that went missing, or the owner withdrawing stock. All of that must be taken into account. Now, adjustments on the income statement that they usually ask, specifically in matric, is the one specifically to the companies. And the first one we have is the director's fees or audit fees. These calculations is usually very straightforward. The directed fees or the audit fees is payable to the directors in a form of a salary, same to the auditors. They have a fee that they charge for auditing our books, and we are going to most likely still owe them money, and it will be recorded as an expense to the business, and whatever is still owed to them will be the accrued expense account that will be recorded in the balance sheet. And the same for the audit fees. Then salaries and wages. Guys, all of you make a mistake with this, or most of you mess up the salaries and wages adjustment. Now this comes from grade 10 with the Salaries and Wages journal. And they most of the time say that an employee was omitted from the salaries journal, or he was on leave and wasn't paid yet. That will be a wage worker. And now you have to incorporate that. So, for the income statement, you have to record the total gross expense, the total cost to company for that specific employee. So you have to work with a gross salary or wage, not the net. The net is what you are going to pay him, what you owe him. When that part is the liability going to creditors for salaries. So in your income statement, you record the total cost to company, which is your gross salary. Very important. And then additional contributions is what you pay on behalf of the employee to the medical aid and things like that. But you have to pay it out of the business pocket to the funds. So paying it out of your pocket is the expense part, and that has to be recorded on the income statement. Note that sometimes they either have expense accounts separately or contribution accounts separately, or they say it is also added to the salaries and wages account. So just make sure what the adjustment says. And then you will, all the accounts, the creditors for salaries, the fund accounts, they will appear on the balance sheet. So those are balance sheet adjustments, trade and other payables. They do not belong in the income statement. The next one is a rent adjustment. They always put in a rent adjustment where you have to work out what the final amount missing or paid in advance will be, and you have to look at different things. So first of all, the rent was paid 1 month in advance. But note, there was an increase with 10% from the month or per month on the 1st of November 2019. The total pre-adjustment trial balance amount is 114,750. That means if we look at our financial year, which started in March and ends in February, they say we've paid to the end of 1 month in advance. So March is 1 month extra. So that's 13 months, equaling the 114,750. That includes the 10% increase. So we have to go and look how many months was usual rent, how many months were increased. So we have 5 months increased and 8 months usual rent. So you can either work with X's and Y's if you want. That confuses a lot of you. So we work with percentages. So we have 8 months of 100%. And then we have 5 months where we increased it with 10%, so 110%. And if you work out, you will have 1,350% as a total that equals that rand value of 114,750. Then, now you always go back to known over unknown. So I want 110 and I have 1,350%. So you work out your rent is equal to 9,350 that you have to deduct from your rent amount, because that is the 1 month that is in advance. And if you do the X or a calculation or the Y calculation, you put Y as the missing or the original rent amount. So 8Y plus 5, where Y increased with 110%, and eventually you will see that you work out Y. But if you use this method, you must realize that you are calculating the amount before the increase, and you have to just add 10% there to get the same answer as 9,350. So there's yet again more than one way to skin a cat, as they say, and calculate. Use the one that is easier for you. Then we continue to the balance sheet. Now the balance sheet, guys, the format and the layout is super, super important. You have to know the layout for the balance sheet off by heart. And you're going to have to make sure that you know assets, liabilities, and equity. Now the first note of the balance sheet, you cannot complete the balance sheet if you don't complete the notes, because the notes are the calculations for the balance sheet. Most of the time they ask you note 3. And this normally can carry about 20 to 30 marks all on its own. So you need to really understand this. Now it's in 3 separate sections. The first section right at the top is your pre-adjustment amounts. Just be careful, that is your opening balances. So if there's an adjustment that said you have already recorded new equipment purchased or you've already recorded the sale of the asset, you have to work back to get to the opening balances at the top there. The middle part is the adjustment part. So that is the adjustments. What do we need to move or make less or add back? And then finally, the last part is the post-adjustment or after the adjustment. So you're going to have pre-adjustment plus adjustment gives you post-adjustment. I specifically want to just have or highlight the disposals at carrying value. They usually want you to show this and specifically show how you get to that carrying value of 10,200 Rand in brackets, because it will help you remember to make the proper calculation for accumulated depreciation at the end of the financial year. So you have to compare apples with apples to get the final answer. So we're going to go to the top. Cost plus additions at cost, but now they say disposals are carrying value. So that is why we have to go back to the cost of the disposal that you have to minus to get the cost at the bottom. So the cost there of 314,000 or plus any additions, in this case nothing, minus the cost price of the disposed asset will give you the cost price at the end of the financial year. Yet again, now we're comparing pears with pears or bananas with bananas, something different. The accumulated depreciation, we have the accumulated balance at the beginning of the year, then minus the disposal plus the current depreciation will give you the accumulated depreciation at the bottom. Do not make the mistake just to go equipment and then depreciation there and the bottom accumulation at the bottom, because then you forget to take that 13,800 away from the sale of the asset. So that is why I say always show cost price minus total accumulation gives for the disposal to show that carrying value, because you need it to calculate the bottom part of your note. Then a new part is, or to the balance sheet, is your share capital note. So yet again, this is very easy marks, but there are a few things that you need to know. First of all, the layout. They don't give you this in detail. You have to always fill in most of it. So, and here they love to work from the bottom up. So they sometimes don't give you the opening amounts, but they give you the final totals, and you're going to have to work from the bottom up to the top. Very, very important things that you usually forget to show is always when you have shares issued during the year, always show at what price did you issue those things. And then finally, your 170,000 when you repurchase, minusing. Anytime we minus something in accounting, what should happen? It should be in brackets. And you think I'm silly, but you forget your brackets. And then you will lose all your marks. So make sure that you don't forget your brackets there. And remember, repurchase is always at average issue price. You cannot give or pay back the full amount from your shares, because that was not the value of the shares. You're obviously going to pay the guy more, because he wants to make a profit. So we have to always calculate the average issue price, and that's your total rand value of your shares in issue up to the date of sale, divide by the number of shares in issue. So in this case, it will be the total rand value divide by the total number of shares to get your 8 Rand 75. And please show at average issue price or at ASP, average share price. So make sure that you have that specifically there with the amount, because you will get marks for that. And if you don't write it down, you forfeit easy marks. And then finally, you must know that that amount, your final total, is the amount that you carry onto the balance sheet. So regardless what you do, guys, take these amounts to your balance sheet, because we have to check on the memo. It usually say, see the calculation for ordinary share capital, and we make sure that you carry that onto your balance sheet. Then your retained income note. This one you always forget the layout, and that is why you lose most of your marks, because this is actually most of the time all given information. Your balance at the beginning of the year is from the trial balance. Then net profit after tax. Please make sure you know when to use before tax or after tax. 99% of the time you use the amount after tax, because that is what you are going to, or specifically in retained income, it's after tax, because that is the pure profit that you have left over to distribute to the company or your shareholders. And that is what the retained income note looks at, the distribution of profit left over, retained. So you calculate your after tax from your income statement, or what they usually do is they give you the tax amount and then ask you to calculate backwards to get the amount after tax or before tax. So you're going to have to just work out. So if you look at this calculation, they give us an income tax of 420,000. They tell us we have 28% tax rate. It's usually 28 or 30%. Yet again, use what is given to you in the question. So before tax is 100%, minus tax gives you after tax of 72%. So yet again, I want the 72, I have the 28 times the rand value gives you the amount. So you're going to have to be able to work back from tax as well to give your after tax profit. Then your repurchase of your shares. Make sure that it's your repurchase price, in other words, the price that you paid for the repurchase of the shares, minus your average issue price, is the part that you had to pay from leftover profits, because that is the part that the other guy most likely will make a profit from. So you are losing profit because you are selling it or rebuying it, repurchasing it from him. And then your dividends on ordinary shares. Now, ordinary share dividends or dividends on ordinary shares is a total of interim dividends, or your what they call paid during the year, okay? And then your final or recommended dividends. Now, where will you find these? Now, usually your interim dividends is from your trial balance. That will be the nominal section account dividends on ordinary shares. And then your final or recommended will usually be an adjustment where they say there was a final dividend declared of whatever percents. So that is why, yet again, show the bracket calculation, because you earn part marks. And if your totals are wrong and you had no bracket calculation, you get 0 marks. Then, moving on. This is now our completed balance sheet. So the notes we were just talking about, fixed assets, go to fixed assets there. Then inventory, trade and other receivables, cash and cash equivalents. Guys, in matric, they usually do not ask you to do the notes to those things, but you will have to know what goes in those notes, because you have to show the bracket calculation for those items instead of showing it in a note. And if you don't know what's in the note, you don't know what needs to go into the bracket. So yet again, knowing your layouts is super important. Then shareholders' equity, we just looked at that. And then your retained income. These amounts must be carried. If they ask you to calculate it in number 1.2 and 2.2, you're going to have to carry it into 2.3 here. And then what I want to highlight yet again, one mistake that you usually do is the green, where you forget to transfer the current portion of your the fixed deposit that matures becomes cash. So your investment is less, but you're gaining cash. So you have to move your investment and put it into cash and cash equivalents. And yet again, the same will apply to your loan. So your current portion of your loan must move from your non-current liability. It's not current or non-current anymore. It is due within the next year, and you have to move it there to the current portion of loan. And then finally, your shareholders for dividends. Do not forget to put the final dividends declared, what you still owe to, or you haven't paid it to your shareholders yet, you still owe them that money. So you have to show your shareholders for dividends as well. I just want to make you aware that the shareholders for dividends and the current portion of loan can also go under the note, trade and other receivables. So just see where there's space. Usually they prefer you putting it on the face of the balance sheet, but sometimes they throw it into note 8, the trade and other payables. Moving on, difficult adjustments is the loan adjustment. They like to give you their loan from a few years back, and they want you to calculate the current portion of the loan. In other words, the part of the loan that will be payable within the next financial year. And you first have to calculate, what have I already paid? How much of the loan payment is still, or of the loan term is still over? So in other words, let's look at an example here. It says the loan has to be repaid over 6 years in equal installments. From the 1st of October, and we have made the first repayment on the 1st of October. Now, be very careful. They say we received the loan on the 1st of September, but we started paying back on the 1st of October. So your loan repayment will only come in to play when you start repaying back. So your payment terms is from first date of payment. So we have our first year, we started repaying on October, so that's 5 months. Then the second year, 12 months. Third year, 12 months. So currently we are in the third year after we've had our loan. So we have 6 years is 72 months. We have used 5 months in the first year, and then 2 years passed, so that we have 43 months left over. I want the next 12 months. So 12 over 43 times the loan value at the moment will give you the current portion of the loan. They love asking one of these adjustments. Go through past papers, practice as many as you can. Then moving on to the cash flow statement. Now the cash flow statement is an inflationary times. It is expected to rise your selling prices and generate sufficient funds to cover your operating expenses. So that is not always true, because if it's high inflation, then people's buying power decreases, etc., etc. So when you're in a recession, your liquidity can become a problem, and that is when we need to know what is specifically happening with our cash. The income statement and the balance sheet is prepared with the concept of the matching concept. So in other words, it's contaminated. You have prepaid expenses and accrued expenses and things already in there to calculate total profit. Profit is not necessarily all purely cash at that very moment. So that is why we look at a cash flow statement to take out those sort of little parts of contamination and look at pure cash flow items only. Now the basic layout of a cash flow statement, yet again, cash flow statements is not difficult. Most of the time you struggle with a cash flow statement because you do not know the layout. So first of all, we have cash generated from operations. What is operation? Running your business every day, buying and selling stuff. Then investing. How do I sort of use my capital to expand my business with? And then finally, your financing. Where do I get funds to actually buy equipment and things from? So loans and issuing of shares, those are all financing activities. So know what belongs in an operation, what belongs in investing, and what belongs in financing. If we now look at cash flow statements from operating activities, there's sort of 4 parts. Now, you have to first work out the cash part of the profit. Now, the income statement, we say, will include non-cash items, like your depreciation, like your taxes that is prepaid or accrued, or even your interest. And we have to take that out to look at purely operating profit. So first of all, when it comes to interest, we'll look at the cash generated, purely cash generated in the next slide. I just want to highlight interest paid. Now, when we have interest paid, you can also have, you have to look at the accrued expenses and make sure that all interest is on payable up to date. And if it wasn't, you have to take that into account. So what was accrued last year will obviously now be paid, plus your income statement amount, because that shows the total due for the year, paid or not, and then minus what we haven't paid yet to get the actual physical cash amount. Same with dividends. You have to look at what did we owe last year that we have now paid, what was the full dividends that we had to sort of declare and recommend and paid in the interim, and then finally, what do we still owe, minusing the 5,600 to get the cash value. And then income tax, yet again, what did we owe SARS last year? What did we have to pay in total for tax? What did we not pay? What was still payable? Please just be careful with SARS income tax, because SARS could have owed us as well. So if they owe us, this first one, for instance, will be a minus, because now they will keep back a credit balance, then we owe, and then we'll see what's left over. So just make sure that when you have income tax, that you make sure is it under trade and other payables, do we owe them? Or was it under trade and other receivables, they owe us? So then we're going to we would pay less in cash to them, so minusing it off the total amount due, and then minusing off what we still owe would be the final amount for cash paid. Then if we look at cash generated from operations, this is one of the few times that you use profit before tax, because you have to now calculate the pure cash profit, and the tax already we don't want to include because we show it separately on the face of the cash flow statement. So you start with before tax, one of the few times that you use the amount before tax, very important. Then we have to take out any non-cash items like depreciation, interest expense, and then of course looking at your changes in working capital. If there was a change in what is working capital, so working capital is stuff, your stock capital, or I have it physically there that I can change into money, or the debtors, the debt they owe me coming back into the business in the form of cash, or the debt that I have to pay my creditors. So remember, cash flow is about coming in and going out. So if it's a cash inflow, it's positive, and if it's a cash outflow, it will be negative. So if we think about change in working capital, we look at the change in inventory, the change in debtors, and the change in creditors. Now, if it's an increase in inventory, it means we purchased more inventory, so cash went out, even though inventory came in. But we're looking at the cash going out. So that's why it will be in brackets. In this example, there was an inflow because we purchased less from the previous year to this year. So there's an inflow because we spent less on stock. Then an increase or a decrease in debtors. Do they pay their debt? I'm getting and I'm receiving money, or didn't they pay me and the money is still stuck with them? So in other words, an outflow. So if there's an increase, they bought more on credit, owing me more money, no money coming in, therefore in brackets. When it comes to creditors, if I pay them, that's an outflow. So if there's a decrease, it means I paid my creditors more than last year, and therefore it will be an outflow. And then you work this final calculation. You take your before tax, you add back your non-cash items, you add plus or minus your change in working capital, and you get your final profit according to your operating activities. So when it comes to the extract or this information, the change in working capital, you'll find it usually in the extract to the balance sheet. So you're going to go and compare the amounts from the balance sheet from last year to this year. Be aware, as I said previously, that when we do this, we exclude SARS, we exclude dividends, and we exclude interest, because this will be shown separately on the cash flow statement. So if we look at the second part, cash flow from investing activities, this, guys, is really super easy. You take your fixed assets purchased, so you look at what did we have last year, so the carrying values. Remember, now we want the cost price because that is what your purchase price will be, and they now working with carrying values. So we're going to just have to work back depreciation. So you take your carrying value from your balance sheet, then you'll have your disposals and your depreciation to get carrying value at the end of the year. So you're going to have to work back to get your balancing figure. So your amount at the end of the year plus back your depreciation plus your disposals minus your opening balance will give you your amount there. And then obviously you carry it to the top. Proceeds from the sale of assets. Remember that asset disposal in the cash flow statement will always be at carrying value. So you will sell it at the carrying value of that asset. So there's no profit or loss that you need to calculate here. It will always be the carrying value that you sell it for. And then finally, if there's an increase or a decrease in your fixed deposit amount, and that you can see from your from the balance sheet itself. And then finally, your financing activities. So now your proceeds, this is how does the business make money or gain cash for that matter. You borrow it or you gain it through capital by issuing more shares. So you issue new shares, or, shucks, I had to buy back new shares, which will influence my capital going out again. And then, obviously, increasing or decreasing your loan. If you increase the loan, it's flowing in. If you paid back your loan, it's flowing out. And then, yet again, remember that our repurchase price is not the average issue price. It is usually higher than the average issue price. So just make sure. In this specific case, they say on the 1st of September, we bought back at 80 cents above average issue price. So you had to yet again go back, calculate your average issue price, and add the 80 cents there. So average issue price, yet again, total rand value over your number of shares in issue, and all of the information will be given for you to work this out. They never give this average issue price formula on your formula sheet. So it's one that you have to really know off by heart. And then finally, we combine all three spaces or all three parts into one financial or cash flow statement. And just to highlight, we're going to go from cash affecting from the operating activities plus the cash flow from investing plus your cash flow from financing will give you the net change in cash and cash equivalents. In other words, this is the cash flow for the year. That is what we have in our bank account. Okay, so the 246,110 Rand will be your bank balance. So yet again, you can check that, or the bottom up is the balancing figure. So cash and cash equivalents at the beginning of the year and cash and cash equivalents at the end of the year. So you have to take these two into account to get back to that amount. Remember, if we had a bank overdraft, you're going to have to take it into account because it's not part of cash and cash equivalents because it's part of a liability. So it was an outflow of cash. So you have to take your cash and cash equivalents balance of 180,000 minus that liability that you had, and then get the opening balance, and then end of the year balance. And then you bottom up. So from top to bottom and bottom up, you must get the same amount, and you know that you have done your cash flow statement correctly. Then, interpretation of financial statements. This is usually one of the questions that you dread, and it's technically very easy marks most of the time. Now, the main thing is that you don't know how to actually come to a conclusion or how to actually just start these things. So first of all, step 1 is to know the formula regardless of the fact that you receive a formula sheet. The formula sheet does not give you specific headings. It's just a random, or not random, but it's just a list of the formulas, and it doesn't give you the name of each formula. So my suggestion is that you take the standard formula sheet that you received in the prelim exams and go and write in the name of each formula and where you are most likely to use it, and then study that off by heart. You can use your formula sheet just to quickly recheck something and make sure of it, but that's not your be-all and end-all when you answer these questions, because if you don't even know the formula from the start, you're already on your back feet when you are starting this. Then you calculate and determine your answer. They will usually tell you to calculate whatever ratio. Quote figures and compare to the previous year. It's giveaway marks, boys and girls. This is really the part that you throw away. It says quote figures, but then you randomly start just rambling on about is it good or bad or whatever. Start with liquidity. It went from 0.3.5 to 1 to 1. There was an increase of this to this. So state the obvious. Quote the figures. It's given information. And then comment on the possible reason. So after you have stated the obvious, last year was this year was this, there's an increase or a decrease of that, then you can tell me what does it mean. And that is where you get 1 or 2 marks. So I'm not going to go into too much detail, but no, profitability and operating efficiency is calculated by your gross profits and your operating profits versus your operating expenses. So you have to look at all of those things. Make sure that you compare to the markup policy. Make sure that you compare from last year to this year, and then look for things that can indicate an issue in terms of cost. Then the next one, liquidity. Just liquidity ratios, there's 3 only. Your current ratio, your asset test ratio, and then your stock turnover ratio. My suggestion is, if you can, use current ratio and asset test first before you calculate stock turnover. Because most of the time, they will give you enough information to do the first 2, and that will give you a clear picture of what you now need to answer. So if your current ratio is fine and your asset test isn't, then you can do stock rate to prove why your asset test isn't good enough. And remember, it is always current assets divide by current liability, so that should give you the 1 point something or the 0, whatever. 2 liabilities divide by itself, 1. So the assets part is the comma something or the 1 point something, where the liability part is always the 1. Okay? Then when we look at solvency, yet again, this is long term. Total assets divided by total liabilities, and liabilities by liabilities. So the asset part is your 1 point something or your 0, something to 1. And then hopefully it's more than 1 to 1, because 1 to 1 means you can pay debt and you're breaking even, basically. Solvent means you have more assets than liabilities, and if you have 0, something to 1, it means you are bankrupt, you're not doing so well. So what should you do? So you have to refer to the solvency of the business. The business is solvent, or the business is insolvent, or it may not be able to continue in the future. So when we now look at examples of debt, okay, so first of all, they comment here, they ask about liquidity, and they say, comment on the solvency of the business, solvency, and quote one financial indicator. So when they say quote the financial indicator, it means you have to say solvency is assets, total assets, to total liabilities. Give the heading or the name of a solvency ratio. And then compare last year to this year, there's an increase of this. Why might that be? Is this good, or there's a decline? So if there's a decrease, it's not so good, or there's an increase, that might be good. Then you only comment. So the last line is one of the marks. So if you see here, it's 1 mark for commenting, 1 mark for figures. If you didn't do figures, most of the time, your comment is completely wrong in any case. So make sure that you first get the marks for quoting, because that's most of your marks. Second, yet again, you get financial indicators, liquidity. So say, name the liquidity. So name, asset test, current ratio. You get marks for actually saying those two things. And then stock turnover in this case. Then figures, from this to this, from that to that. There's a specific increase. And then why that might be a problem or not. Okay. And if we continue to debt equity. Now debt equity, debt, long-term debt, your liability loan to your shareholders or your equity. So in this case, when they talk about debt equity, they always talk about some sort of loan adjustment. Is it a good idea to pay back your loan or not? That is when you use your debt equity ratio. So you will always have to compare your debt equity, or do you want to take out a loan? What is your debt equity ratio? Or am I credit worthy or not? So they say if the ratio is less than 1:1, you are credit worthy. You have good gearing, favorable gearing. And if you have, in other words, less, so you have less debt than equity, that's great stuff. If you have more debt than equity, not so good, obviously. And they're going to have to look at your ability to pay back the loan. And most of the time, they will not grant you the loan if your debt is more than your equity. So then return on total capital employed. This is also, yet again, if I am investing the money in my own business, is that giving me a better return, or should I have rather take that money and pay back my loan because my interest rate on my loan is higher than the return I could have gained in my investing back in my capital or back into my business? So that is what return on total capital employed means. So is it a good idea to pay back the loan or not? Because I get more return or less return from my capital employed. So if I look at an example, they say, explain how the loan affected the risk and gearing and whether or not it was a good idea to increase the loan or not. Okay, so in other words, the moment they talk about loan, you always quote your debt equity and your return on capital employed. Those are the two ones. The moment they talk about is the loan a good idea or bad idea, or is pay back on the loan good or bad, you always quote those two analysis figures. So yet again, you first get marks for quoting the right figures and comparing from last year to this year. State the obvious when you do this. There was an increase from last year to this year, so this was an increase or a decrease in your risk. And therefore, compared to the interest rate, current interest rate, it was a good idea or a bad idea. So take into account everything before you comment. And if you see out of the 7 marks, the comment is literally 1 mark. So even if you don't know if this was good or bad at the end, if you quote your figures and you state the obvious, you will get most of your marks in analysis. So, general knowledge, just to recap, is that your current interest rates is very important to know. You must know or be aware that what your current rates are in terms of borrowing money or even investing money. They sometimes give it, but you get bonus marks for actually knowing the current financial rates. So keep your eyes in the news. Okay. Negative gearing, in this case, because the return on capital employed is less than the interest rate, and it decreased. So you don't actually want, it wasn't a good idea to pay back this loan. You would rather keep it in there and maybe think about, oh, no, excuse me, I'm talking the wrong way about. So they are experiencing negative gearing. So they have to take steps to improve their financial spaces. So it wasn't such a good idea to pay back the loan. They should rather keep it in the cash and maybe reinvest or advertise or something to improve their profitability and then continue to the future. Okay. Then return on shareholders' equity. Now, return on shareholders' equity and dividends per share and things like that, that is the money your investors get return on. So is your business a good investment or not? This is where they calculate that. So earnings per share or dividends per share. So you look at those three things. If the question states something about is there a difference between these two businesses? Is business A a better investment than business B? Or this investor has decided he wants to invest in your business. Will you suggest that yes or no? You quote your return on shareholders' equity, your dividends or earnings per share. So you'll get most of the time given indicators. Sometimes they ask you to actually calculate the earnings per share or dividends per share. Always, guys, when they talk about dividend payout policy, they want you to make sure that you compare earnings per share and dividends per share as a percentage of each other. So you're going to say dividends per share over earnings per share as a percentage of each other, so that you can compare that from the one year to the next. The directors, they say in this case there was the earnings per share, dividends per share was 56 cents, the earnings was 98 cents per share, so there was a 57% payout rate. And then it decreased from last year with 88%. So obviously that is not really such a good thing. They say here, the directors want to appease shareholders for poor performance. So they want to pay out more, but they really actually couldn't afford it. So they have to really look at paying out what they do there. Then net asset value is quotable when they talk about the JSE. So they say here, is the new shares issued at a higher value? If the new shares are not sold at a higher value, it depreciates the value of your shares, and therefore you have to look at the actual figures versus the market price of your business. So when will it be profitable for the shareholders to sell their shares? Obviously when their net asset value is more than the market price, because then they're going to, no, the other way around. When the market price is higher than the net asset value, because then they gain money by selling it. So here they say, the example we have here, Richard D owns 50,000 shares and he decided to sell his shares on stock exchange. Provide two possible reasons for his decision. So you can now see that they quoted the net asset value versus the market price. And they say the demand for the shares is lower, reflecting that the image of the business. So you can see that the image of the business is declining. So he would rather have to sell it, or they have to pay back their loans. And you're going to have to decide, weigh it up. Is it a good time now to sell it before everything goes down the drain, or hold on to it a bit more and see if it improves or not? And that is what you're going to have to look at finally. So if you sell his shares, they can also ask if it is a good investment to buy more shares. Obviously in this case it wouldn't be such a good idea, but in other cases it might. Then we get to ethics, governance, and the role of the professional bodies. Now this is normally also a question on its own, or it can be incorporated into other questions throughout the entire paper. So you can be integrated in all the relevant topics. As I said, the questions will be based on short case study based scenarios. So guys and girls, the practical problem solving recommendations, but Stick to what is actually given in the case study. Don't answer with a what if in the back of your mind. Focus on what they give you. What is the problem there and how can they solve it there? Or what can the possible solutions be? Bring in obvious internal control issues. So yet again, you have to know what is your internal control problems and make it practically related to what is happening. So as I said, do not answer with a what if in your mind. Stick to the scenario. Answer what with what you have. The answer must come basically from the information. The information must guide you to what you are answering. Corporate governance, they say the effective, responsible and ethical management of the company. So did the directors and the CEO, were they ethically correct in handling a certain situation? Yes or no? Yet again, it will be case study based. And if they did something wrong, okay, so just need to know about the different types of, so if we go to the board of directors and the CEO, how did they manage the business? Was it good or was it bad? Did they do something wrong? Yes or no? Was it ethical? Can they then catch up? And if they did something wrong, was it so bad that they will end up in jail or need to be fired, or will they just be reprimanded, need to pay a fee, a fine on it, etc., etc. You need to know the two types of directors with the emphasis on the executive as used in the CEO. So in other words, when they talk about an executive director, they talk about the CEO. Or the other type of directors, those are sort of the general managers, and you can also have directors that are not so involved. So they are not there necessarily every day, but they are on the board of directors helping with decision making. And then work on specific committees to ensure accountability and transparency. So your audit committees, your remuneration committee, your ethics committee. So some of the directors, as I said, will only come in to do work on one of these committees. And they're not necessarily there, part of the daily running of the business. Then pollution and environmental awareness. This is a very important part these days. And then yet again, your skills development, wealth and job creation, and project, your social investment, corporate social investment. This is very, very big in the papers these days. It is up and coming, especially in terms of what is happening in the current news. They will take out little clips of newspaper clippings and bring that in. There was a wastage spill. Now, what is the company's responsibility regarding this wastage spill? Yet again, you cannot just answer randomly, and you have to focus on what they give. So if they talk about a wastage spill, answer about environmental issues. They might be fined. They have to pay for the cleanup, things like that. You cannot now say they will just be going to jail. That's not a proper answer. Have the information guide you to your answer. Then responses should be based on common sense and logical courses of action, case study based. So in other words, it cannot be things that you thumbsuck and just, as they say, grab out of thin air. Stick to what the information is. And it's not things that you can really study like facts that you can study pre-off. So you have to then focus on what the case study tells you to answer these questions. Professional bodies, the need of a code of conduct. So what is the code of conduct? Just generally, professional development and disciplinary roles. So how does the business provide professional development? How do they discipline their employees? What may lead to a possibility of dismissal from a professional body in the event of misconduct? And this is important. Possibility. You can never say for a fact that someone will be dismissed because you do not have all the information and you're not a lawyer. And so yet again, always say there's a possibility that this person may be dismissed, or he most likely will get a fine or a warning or whatever. Then know what is SAICA, South African Institute of Chartered Accountants. So what is that? They provide support and advice services to its members through their professional lives. So they come in and audit the business, give entrepreneurs certain advice and help them expand their businesses. And then also SAPA, the South African Institute of Professional Accountants. You have to be registered there in order to help people make sure that they apply the rules of GARP and the newest regulations of IFRS and things like that. They play an active role in professional code of conduct and making sure that everybody is following the rules, and obviously continuing in their education as the tax laws and things change. What is the newest developments of specific accounting procedures? And then finally, we have our little parrot here. So guys, it is, as I say, remember to start your paper with the best things first. So that what you know best, start that first. Read your paper first, decide which active or which question looks the easiest and stick to it. And then start that one, the one you studied hardest on. Then Parrot study all formats and layouts from statements. It is super important. The easiest way to gain marks is literally first going to write down your layout, taking the information, writing down what you can in the layout first, and then looking at the adjustments and additional information to put back the missing figures. So you sort of work from the back to the front in accounting. So don't just start and jump in from this and just go with the first transaction. Start with the layout. Take the minute or two that it takes you to first put the layout down in the correct order, because that calms your mind. It helps you to find the correct information, and then it guides you to the missing stuff and you know what to look out for. Then Parrot study your formula for the analysis regardless of the formula sheet. So the formula sheet will not help you if you don't understand the ratio or the name of the ratio or where to get it or where to find it. And you must be able to identify which ratio to use where. So if they talk about profit, you know to use your profitability ratios. If they talk about liquidity, what is liquidity? The 3 liquidity ratios must immediately pop into your head. If they talk about something about loans, what must come into your mind? Your debt equity, your gearing, your return on total capital employed. If they talk about is this a good investment or not, dividends and earnings per share, and your return on shareholders' equity. You really need to know these types of questions linked to these formula. So if there is any questions, you can go back and make sure that you practice and practice and practice past papers. More you practice, the fitter you get, the more you realize what type of questions they ask. And we cannot reinvent the wheel. They take past papers, change a date, change an amount, but the basics sort of come up over and over again. So the more you do it, the easier it gets. And as I said, Parrot study, start from the back to the front. Layouts first, relevant given information on top of that, and then only start figuring out the missing information and the adjustments. I hope that this makes things a bit clearer. Good luck for your exams. Study hard, prep before, and don't cram the night before. Get a good night's sleep. Good luck, everybody.